Hey everybody. So in this video of Mortgage Secrets, I'm going to be sharing with you in a lot of detail what fees make up the closing costs. So in this scenario, we're going to use Clark and Lois. Yep, they're Asian in this scenario, but Clark and Lois, they're looking for a purchase price of $350,000. The loan amount or the down payment that they're going to be putting down is 5% of that, and that's going to be about $17,500, and the loan amount is $332,500. They have decent income, W-2 employees, and their credit score is 720. Now from here, we're going to look at a few scenarios so that we can understand what fees actually make up the closing cost. But the first thing I wanted to share with you is, I'm sure if you've been shopping around already, that a typical estimate that you're getting is going to be this loan estimate or a fee worksheet. I think the con about this loan estimate, so the idea of the loan estimate when the CFPB decided to make this a standard is that they wanted everybody to be able to shop around and receive a similar type of documentation. I think the intent was good, but the con is then you're going to be receiving multiple PDF files from different lenders, and the different lenders or loan officers are going to be providing fees where certain fees might be included, some might not be included. They might be inflating certain fees or actually deflating certain fees just to win you over. And so through this process, I'm going to show you how I would compare the loan estimates or cost side by side if I was shopping around, but also in detail walking you through what the closing cost fees are going to be. All right. So we developed this in-house. This is basically our loan scenario model. And in this model, we're able to kind of look at it side by side rather than going to this loan estimate, printing out 3, 4, 5 different quotes and trying to figure out what makes sense. Why is one loan estimate saying a fee one way versus a fee another label and a different loan estimate? Why does it include one fee and one estimate and not another? This really gets to help me understand the loan scenario model that we built side by side, what buckets are in. So first off, as I said, Clark and Lois are purchasing a $350,000 home. Their down payment is going to be 5%, which is $17,500. The loan amount is $332,500, and we're going to be looking at a 30-year fix. Now, I'm going to be walking everybody through the difference between the closing cost differences between a conventional loan, an FHA loan, and a VA loan. Those are going to be pretty much the three bread and butters. There is the USDA loan, but we're going to be focusing on these three options for now. All right, so if we go down here, the first thing that you're going to see is the rates. I try to keep it pretty steady across, so 2.94, 2.99, 2.99 for the VA, FHA, and then the conventional. You'll see very first, if you look at it side by side, is that the mortgage insurance on the conventional loan is much lower than the FHA, $52 versus $219. VA, there is no mortgage insurance, so you don't have to worry about that. The property taxes, in this case, Clark and Lois are living in Montgomery County, Maryland, and the property taxes are 0.94% annual. We're going to be just doing it off of the purchase price, saying that the purchase price equals the assessed value of the property. And I'm going to be using 0.94% for that calculation. And then I'm going to also add on an additional, let's see here in the math, an additional, I'm going to add this, $100 for their homeowner's insurance. Okay. There you go. So that means their fully loaded housing payment is going to be $1,822.75. If they have a HOA for the property that they're going to be buying, then that's going to be added onto their fully loaded housing calculation. All right, for an FHA, if we look down here, mortgage insurance is higher, and so the PITI fully loaded is going to be higher. And then for the VA loan, because there's no MI, then it's going to be lower than the conventional loan. So most people ask, okay, typically VA, if you're VA, it's going to be between VA and a conventional. You're really not going to be considering the FHA. And for non-VAs, it's going to be between the conventional and FHA. So folks ask me, why would I go into an FHA and why would I go into a conventional? At the high level, FHA allows a little bit higher in debt to income ratio, so you have a little bit more liability, so we can squeeze you in there. Also, another thing is it allows a little bit lower in credit score qualifications. Right now, this scenario is based on a 720, so we're trying to keep everything level. But that would be reason why I would suggest, you know, somebody to go into an FHA if their DTI is a little too high or if their credit score is a little too low. Otherwise, I would be advising the clients to go into a conventional loan, because in a conventional loan, the MI is much lower and the MI will automatically go away once you hit 80% LTV. Whereas in FHA, you are going to have to refinance out of it. So that's one of the reasons why I wouldn't advise a client to go into an FHA, because then you have to refinance out, which means there's going to be additional costs associated with that refinance transaction. That's going to be one of the reasons. Now, if we go into section B, and that's another thing that we did with this model, is we try to mimic the loan estimate. So if we go into the second page of the loan estimate where it's the details, so if we go down here, it's all broken up into what the loan costs are, section A, B, and C, and then the other costs, which is the tax and insurance, prepaids, the escrow, and then the other, which is the owner's title coverage. Okay, so we try to mimic this, but this felt really choppy to try to compare side by side. So what we did is we built this side-by-side model to include all the fees. So section A, which was that lender charges. So in here, you'll see the underwriting fee that the lender is charging of $999. And then here but there's no points or lender credit for it for the conventional, and this is what we call par rate. There's no credit or points for this rate. FHA, there is $6,700 in lender credit for the 2.99, which is kind of offsetting the underwriting fee. Now, a lot of people will be like, oh my God, I'm getting $6,700 back. That's great, right? That's why I should go with an FHA. Well, for an FHA, I'm going to skip a little bit ahead, but there is an upfront MI, mortgage insurance, of $5,800. So, you know, this $6,700, most of it is going to be used to offset the upfront MI. Now, you know, some loan officers that are going to be watching this video, they're going to say, hey, you could, to be able to finance that in. Yes, you can, but then that means that the rate's going to be inflated as well, because nothing is free, right? So it's going to impact the rate somehow if you're going to be rolling in certain costs in. Now, the VA loan, I'll kind of speak to it separately, little by little, but there's no underwriting fee, and the lender credit is a little less, but because that's, you know, there's no underwriting fee, but there's also a lot less fees that the lender is going to be able to charge, and you'll see that in the title section as well. But so if we go down here back to the conventional, there's the underwriting fee on section A. This is what the lender is charging. Okay, so any loan originator, if you walked away from this video with one specific tip, the tip is you should focus on section A. If you're shopping around, focus on what is the rate. So I would say, you know, if I was shopping around, I would call, let's say, 3 or 4 different lenders and say, I was focused on just rate, right? Then I would say, okay, I wouldn't ask them what is your best rate. I would say, okay, I want a 2.875 or a 2.94. Can you send me a quote for that? That way I'm shopping apples to apples. And then when I get those quotes, those loan estimates or those fee up worksheets, I'm going to be looking at section A. What are they charging me for the underwriting fee? Is there any additional fees that they're charging? Let's say an application fee, a processing fee separate, something else fee. And then am I getting any lender credit, or are they charging me points, or am I getting neither? That's going to be the most important thing, because beyond that, everybody else, you know, section B, C, all that stuff is kind of the same. But section A is where we're all kind of being competing within, right? Because this is what the loan originator is playing around with, depending on if they're a broker or they're a direct wholesale lender. Okay. Now, when we go to section B, oh, and sorry, so going back up to section A, one thing that a lot of loan officers will do is they're going to try to see, you know, what are you interested in? Are you interested in getting a lot of cash back, or are you interested in getting a super low rate? And depending on that, you know, they're going to play around with either charging points or giving you a lender credit. Now, if you want to be efficient in the way you're shopping around, I highly recommend to share with the loan officer. If you're willing to pay points, tell them you're going to be paying points, let's say up to 1%, and then to see what it is. Or you want lender credit, or you want par rate, because that's going to help us be efficient, because we're all kind of working out of the same portal, and that'll help us understand, like, okay, they don't need any lender credit, or no, they're willing to pay 1% in points, so $3,500 in points to get a specific rate. Then you're going to have an apples to apples of what they're able to provide. Okay, now going to section B, this is the services you can't shop for. These are the fees that either it's going to be, you know, the lender is charging, so it's the appraisal fee, credit monitoring, flood life loan, you know, credit report and all this stuff, or if it's the FHA or a VA, it's going to be the VA funding fee or the upfront MIP for the FHA. Okay, so these you cannot shop for. Basically, you're kind of, now for the VA, one thing is if you are on disability, this VA funding fee is waived, so you don't have to pay out of pocket for it. A lot of veterans don't know that. And then for the upfront MIP, this basically you have to pay for as part of an FHA. Even though you get a big substantial lender credit, the upfront MIP is this. Now, FHAs, they typically start at a much lower rate. So for par rate as of today, December 16, 2021, for at least for us, the FHA par rate is 2.25, and so is the VA. But there's a $5,800 upfront MI cost that you're going to have to pay out of pocket. So don't be wavered or tricked by, you know, what the rate is. Really, you know, the rate is kind of like worthless if you can't get it. If the loan can't be done, the rate is pointless. It's almost like, oh my God, I love this amazing car, but I can't afford it. What's the point about it? I'm just kind of like daydreaming about it. So keep that in mind. So if we go into the next section for section C, this is a section that you can shop for. Most of the time, if you're going into a purchase, the seller or listing agent is going to provide you as part of their contract, especially these days, that they get to choose who the title company is, because they want preferential. They want to go with a title company that they feel comfortable with. And, you know, I think that would make sense, because not all title companies are made equal. Some of them are ultra slow to respond, slow to complete the title work. And so if a listing agent or a seller already has a title company that they prefer to work with, I suggest go with them, because they've already has experience with them, and they know that that person is going to be doing good work. Okay, so you can see here, title policy. This is the policy for the lender, not for you, that protects the lender if there's any title issues. And I'll get to the homeowners or the owner's title policy as well later, but this is to protect the lender, not you. This is the settlement fee that's paying the title company for doing this transaction for the title. And these are all the other ancillary costs that the title is may or may not charge. Okay. So survey, exam. But you can see that bulk of the fees on section C is the title policy and the settlement fee. Everything else is, you know, it doesn't make up that much. It's, let's see here, $545 of the $2,200. Okay, so this, again, if you're refinancing, you get to shop around if you want to. But, you know, if you are working with a little bit larger brand or a premium brand, like for us, we partner with a few title companies, and we have some preferred discounted measures. And so we get preferred treatment in terms of pricing. So it would be kind of hard to beat that. And then you also don't want to just pick up any mom and pop shop, because you want to make sure that title is done correctly. I mean, it's documentation that's relayed with the court, and the research that's involved in it. So I highly recommend to make sure, don't go for the lowest price, because not all title work is the same, just as not all loan officers are the same. There's only a very small 1% of us that we operate at a such high caliber and high premium, and then the rest, they're kind of like getting by. And I'm sure you don't want to just work with anybody that's getting by just for a rate, because again, a rate is worthless if you can't get the loan. So after that, then going down here is going to be on the other side of the cost, which is the recording these. It's like all the government fees, prepaids, and escrow. So if we go here, there needs to be a recording fee anytime there's a transaction going on for a mortgage for the property. And then the transfer taxes. So for us, as I said, I'm in Montgomery County, the property tax is 0.94%, and then there's a transfer tax calculation involved in it. Now, depending on how your contract is negotiated, the seller might pay a portion of it, or they've already prepaid a portion of it. So, this could be reduced. So this is going to be fluctuating. Homeowners insurance premium, I'm just taking a swag right now because I don't know exactly what the property is. And by the way, this whole quote is for a single family primary residence. So if it was a condo or a townhome, second home, or an investment property, this entire scenario would change. So single family primary residence, that's what we're going based off of. And then title, so owner's title policy. So this covers you. And the simplest way to think about this is, if the lender thinks it's worth it for this transaction for them to cover themselves, I think it would be worth it. A $5 billion, $10 billion, $50 billion company, let's say like Rocket Mortgage or United Wholesale or even a big bank, if they feel it's important to get this, I think you should consider getting it for yourself. And the main reason is it's to cover yourself for title issues. Let's say, a year or two down the road, somebody comes to you and say, hey, you bought this house illegally. This is my property. It's not yours. The title work was not done correctly. This title policy protects you, the owner's title policy. Prepaid interest. So another area that I see a lot of loan officers kind of manipulate is this prepaid interest. They sometimes show 1 day prepaid interest. That means basically that you're closing on the last day of the month. So I typically put 15 days because it's going to move up or down from here, right? So if we close on the middle of the month, then this should be pretty accurate. If you're closing a little bit later in the month, then you're going to be paying a little less. And if you're closing a little earlier, then you're going to be paying a little bit more. So just take this into consideration. That's why I go back to be focusing on section A, right? Or if I go to the loan estimate here for you, it's going to be this section, okay? I wouldn't worry too much about this because this is going to be dictated by when it closes, what your property taxes are, what your homeowner's insurance is, what the transfer taxes or recording fees. The loan officer has no control over. They might be manipulating certain things to make it look better, right? Because you didn't do your research and try to understand it, or you didn't know better, right? But I would focus right here on section A. Everything else is going to be dictated by title or the investor or the taxes. So when we go back here, now the other area that I see a lot of manipulation, and it's kind of like a buyer beware for you, is going to be the escrow account. I see all too often that loan officers will put 1 month of escrow collection or no months of escrow collection. That's wrong. Because if you're going through a brand new purchase contract and you bought that house, usually they're going to collect 3 months worth. And the escrow account is basically kind of like your savings account used specifically to pay your property taxes and or your homeowner's insurance. And so they're going to be collecting at least 3 months worth to get a kickstart to get ready for the next dues that's going to be coming up. And this is going to be, they're going to be paying it on an annual basis, your homeowner's insurance as well as your property taxes. And so just again, buyers beware. Take a look and make sure this is not 1 month or whatever it is, or it's like calculated really low. It should be at least 3 months worth. Okay, and then when you add it all up, it's going to show you what your estimated closing cost is going to be when you add all these fees up, as well as your plus your down payment for Clark and Lois is going to be 17,500. So the total is going to be 29,465. And you can see side by side what it is. So at the end of the day, it's kind of all the same, right? 29, 28 and a half, 28 and a half. It's what it is, your specific scenario. So do you have a little bit more debt than usual? Conventional loan these days, we can go all the way up to 49.99% in the front and the back end DTI. For FHA, it can go a little bit higher. VA, you get the benefits depending on your situation. So one of the main benefits is you can go 100% loan to value ratio. So you go $0 out of pocket. A lot of clients would ask us, I wanna get a home with 0 down out of pocket. The only one that's available for that individual, if they qualify and if they are a veteran, would be the VA loan. Otherwise, first-time home buyers, the smallest down payment that you can provide is 3% for a conventional loan and 3.5% for an FHA loan. So just keep that in mind. There's pros and cons to it, but the best thing to do is to connect with your loan officer and go through your process and scenario. It would be so hard. You can just see from these 3 scenarios, and there's so much more, right? Depending on your down payment amount, your DTI situation, that you will not be able to figure out yourself. So if anything, I highly recommend interviewing a bunch of loan officers to see who you connect with, if they know their homework, how much transactions they've done. And I'll create a separate video kind of explaining and sharing with you what if I, as a loan officer, went into the market and I wasn't able to do my loan and I wanted to go and interview, what questions would I ask? What would I be focusing on to make sure that I'm partnering with the right loan officer to help me for my financing of my new home? With that, I hope you liked this video. I hope this helped you. If it did, please click the subscribe button and smash the like button and comment below. Was this helpful? Is there any other questions based on the information that I provided you that you have? If you do, comment below and I'll be sure to respond to you quickly. Thank you so much and have a great day.